Hello, folks, and welcome to this presentation, and particularly the next module on, my ongoing TW mentorship. And yes, um, if you're watching this video, I suppose you've gone through the first one, and which is defining the high time from institutional order flow using, the COT hedging program. Okay, and that being said, you know, the whole idea of the previous or the first start of this mentorship is so everyone can have an understanding what the high time frame institutional order flow, or whenever I say it, what it looks like. Because everyone talks about order flow here and there, and from what I learned from ICT, Michael, order flow really describes the long-term trend in the market, like a very simplified way to look at it. And there's no way I want to be using it on intraday basis. Okay, that doesn't really make sense, because we're talking about you know defining high time frame institutional order flow on these high time frames. Okay, and we then interpret price action into lower time frame and trade. It's not like I'm trying to define order flow on lower time frame, the 15 minutes time frame, 5 minutes chart. That I wouldn't fully agree with that idea of the high time frame institutional order flow. Now, when we look at the COT data, for example, it doesn't just tell us, if the commercials are, buying or selling. It gives us direct hedging program, and that's the reason why we have, I have this open here, because I think everyone is familiar with this one, and nobody is wondering what this looks like. All right. For a recap, whenever when you pull up this on your trading view, it's this tool here, ICT commitment of traders. Okay, you can search it on trading view. Okay, 2 degrees built this tool, and I kind of like showed you what this tool is like initially, because back in the day when we used this tool, we used to go to barchart.com and plot in the COT data on barchart, and do all of those all of those Da Vinci stuff on the charts. And then we now develop our midpoint, and the buy region and the sell region, just to determine the hedging program. Because the market can, or will I say, commercials can be in a sell program and be hedging for buy side. Okay, they might be in a buy program. And what's buy program? It's simply when the net long is more, when the long positions are more than the short positions, so the net positions is bullish, or net long, you understand? So that's what the net, what I meant by if they're in a buy program, when net long, or they are net long. Basically, net long meaning when you add long positions and short positions, you see they have more long positions, so it's called net long. I think it would have been easy if I was in commercial class, because they used to be gross, nets. It's kind of like overlapping in some ways, probably the same thing anyways. Anyway, so I was trying to really talk about how when we look at the COT data, it gives us the hedging program, seeing what the commercials are doing and how they are actively participating in the market. Now, just looking at this, you can see somewhere in September the market crossed this midpoint, and you can see the market has been really bullish since then. And as soon as we crossed the midpoints down, and we had this market structure shift, we've been seeing lower dollar prices. All right, so this is the COT hedging program, how we define the high time from institutional order flow, for 3 months minimum and stuff. So now, one of my earliest understanding of the high time from institutional order flow, or say how I used to think or how I used to define the higher time frame institutional order flow some years back was I was utilizing, higher time frame market structure. And the truth is, there wasn't really anything inherently wrong with, using the higher time frame market structure. When I mean higher time frame market structure, I simply go to the monthly time frame. Let me take this one off first. I think we'll bring it back. I'll go to the monthly chart and I'll just look at price action like this and say, oh, for example, US dollar index. Oh, US dollar index is bullish. And that's institutional order flow for me. Now, well, that makes sense actually. But the truth is, I cannot use it to trade because how is being bullish on dollar index? How am I going to frame my setups every single week? You see, that's why, the COT edging program and how we, how we define, the high time frame institutional order flow based off of data would help you streamline, your focus to certain things going on, like current market condition, right? But if you look at you just look at market structure like that, and in fact, even today, I would use market structure to still define an institutional order flow, but it's not in the way I used to think, because I used to think that when I look at the long-term trend in the market, like I showed you on the monthly time frame, that's institutional order flow. Well, like I said, it's not wrong, but it will be very difficult to use that information to actively participate in the market, on a weekly basis. All right. And but like I said, everything was just wrong with the way I interpreted, the high time frame market structure. And now I just focus on, candle ranges. And like I said, we revert to the COT data first, because, it's quantitative analysis, or say fundamental analysis, because it serves as the premise through which we can now build, narrative in price action. Okay, I wouldn't just simply go to the chart and say, okay, I'm bullish because of the high time frame market structure is bullish. When I understand that, the CFTC, they publish, open positions in the market every single week, and I know that the large speculators and the commercials are, what we dub smart money in quotes, and they influence price movement. So I think it will be a lot easier understanding the market if I know what the active players are doing. All right, if I can understand what they are actually doing, I can then interpret it into candlesticks, and then now define how I frame my setups and all of that, because it's very, very crucial for us to utilize, the fundamental analysis. That's what, it's called, especially if you just get into trading through baby pips. Of course, everyone goes through baby pips. If you haven't gone through baby pips, I suggest you go through baby pips. All right, so it's fundamental because it serves as the premise or the basis for your technical analysis. I wouldn't discount any of the two. In fact, one of Larry Williams' interview, if you don't know, Larry Williams is, ICT's mentor. I watched a couple of his interviews, a while back, and he was talking about how, chart patterns like, the triangle, the channels, the only reason they work is because there's a premise of, the things going on behind the scenes. And one of the things he used, or one of his, tools in defining, in his fundamental analysis, was the COT report. And in as much as ICT amplified on the COT report, I think Larry Williams gave like the first breakthrough in interpreting the COT data. Okay, and now that we've actually talked about how, the quantitative analysis influence, our decision in price action, how we want to view or actively view the market in real time, because the COT edging program is not going to be bearish and I'm going to just go into the market looking for sort of like bullish price action. Well, that depends. Okay, that depends. I mean, long-term bullish price action. That's what I meant. So using technical analysis, what I call qualitative analysis, how do you then define the high time frame institutional order flow if we've already said, especially for the fact that, using market structure itself is flawed. Okay, if you just simply look at market structure, it's a flawed logic of trying to define the higher time frame institutional order flow. And rather, you would want to use the high time frame institutional order flow to define market structure. So a while back, like I said I would want to think about using or utilizing market structure to define high time frame institutional order flow. But okay, sorry. So, a while back, I said that I'd want to utilize market structure to define the high time frame institutional order flow, and we already see that if you just simply look at market structure, at least if you look at it the way I used to look at it, just going through the monthly time frame and saying, oh, the markets are bullish. Let's go to the monthly chart. Just looking at this, for example, and saying that the markets are bullish, and because of that, you are looking for, bullish price action. You're gonna make lots and lots of mistakes because you're gonna have wrong expectation, wrong ideas of high time frame key levels, wrong ideas of premium and discount. Really just wrong perspective of the market if you just simply look at what the higher time frame market structure is. You understand? And yeah, so what I was saying is, if market structure is flawed, how do you then define the higher time frame institutional order flow? And the truth is, the answer to this question is going to lead us into asking another question, and the question is, where is the draw on liquidity? So if you want to define the high time frame institutional order flow using technical analysis, you want to be looking at where the draw on liquidity is. Okay, where the draw on liquidity is because high time frame institutional order flow bends market structure to its will, and that's the truth. It bends market structure to its will because how is it that the markets could really go lower and still be bullish? For example, if today I was making a tweet on my X account on USDCHF, for example. I was talking about USDCHF weekly time frame, and I said the draw on liquidity here is the fair value gap. All right, and market traded below the previous weekly low. And if we go to the intraday time frame, okay, obviously this is a low and the market made a lower low, and then I'm expecting the market to trade into this high. That's 0.88644, and although 0.88664 overlaps with this high here, which is the weekly fair value gap, which is the draw on liquidity because it's 0.886 blah 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 blah, right? So how is it that a run below this low is giving me the idea that the markets are going to return here? Okay, that doesn't make any sense. It really doesn't make any sense, and that's why the whole idea we're talking about, high time frame institutional order flow. And if we want to define the high time frame institutional order flow, we want to be asking questions like, what is the draw on liquidity? Basically, what is the draw on liquidity? And if you're familiar with sciences, you'd also understand how gravity through a reference mass, okay, bends space-time, I mean, as it propagates, you understand, based off of the Einstein's general relativity or theory of relativity. I know that's science stuff, but if you're into sciences, you understand that when there's a reference mass and through gravity, it kind of like bends space-time, and that's the whole idea of the Einstein's theory of relativity. I want to just reference it to how you can define institutional order flow, and institutional order flow bends market structure to its will. So market structure isn't what you want to look out for, because market structure is subject to the high time frame institutional order flow. And one of the ways we can define the high time frame institutional order flow, especially technically, define the high time frame institutional order flow, is when we want to look at the draw on liquidity. Okay, now what is the draw on liquidity? Because that's a very, very important question. What's the draw on liquidity? Now, mind you, you don't want to be defining the high time frame draw on liquidity outside, our reference. And our reference simply is, the fundamental report, the COT hedging program, because there are different ways you can use, to define institutional order flow using data, of course. There is the open interest. I wouldn't want to say seasonal tendency, but sometimes seasonal tendency plays its part. Okay, it gives you like a generalized overview of what the market should do, at certain periods of the year. All right, but how do you then define the draw on liquidity? Well, I think I made the definition of draw on liquidity when somebody asked me, and after the fact of it, I'm like, actually, this is actually a beautiful definition of draw on liquidity, because I said draw on liquidity simply refers to a near-term price level that markets are willing or unwilling, quote and unquote, because there is sometimes the willing participation for markets to trade into levels, and sometimes there's kind of like unwilling participation for markets to trade into levels. And that's when periods when you want to see, that's in periods when the markets fall into consolidation. Okay, because it's just back and forth, and eventually they find their way into those levels. Okay, and we'll somewhat talk about in the chart. So I said draw on liquidity simply refers to a near-term price level that the markets are willing or unwilling to engage in the near term. So if you can look at your charts, okay, under the premise of the COT hedging program, so you can see how each of these lessons will overlap into each other, right? And that's how I want to create this mentorship. I want each lesson to overlap. So while you're going through one lesson to the next lesson, we aren't going away. We're not taking a new concept. Instead, we are going to amplify the previous lesson with the next lesson, and we go down into the lower time frame, and just develop an actual trading system for you to work with. Okay, so if you can actually define levels, price levels on the near term that the markets are willing or unwilling to engage on the near term, you've successfully defined the draw on liquidity. And the draw on liquidity can be defined in several ways. Now, mind you, you cannot do it outside the premise of the COT hedging program. Okay, that serves as the basis, but not just that. There has to be element of premium, discount, and all of that. Okay, for example, dollar index here closed this monthly gap, and as soon as dollar index closed this monthly gap, the next thing is we're looking for lower dollar prices, basically. And at the start of this month, we saw that last month was bearish, and this bearish close by itself validated March bias. Okay, and we're looking for prices to trade where into the previous monthly low, into this fair value gap, of course, right? And that's how we've simply defined the draw on liquidity, because the draw on liquidity now is what? The previous monthly low. Why is it the previous monthly low? Well, if market is bearish, you're expecting candles to trade into their previous ranges low. You understand? Like this, market's bearish, market's trading into previous monthly low. Market's bearish, market trades into previous monthly low. Market's bullish, market trades above previous monthly high here, trades above previous monthly high here. And you can in fact just go through the commentary from last year in periods when I started talking about dollar index, and you'd really appreciate this lesson even more, because this is how I internalize, visualize, and the market, and that's what I do on a weekly basis. Okay, so Once you understand, premium and discount, and you understand what the higher time frame institutional order flow is, you can simply look at candlesticks, because instead of looking at market structure like I used to, using the generalized concept of market structure, I just apply, the COT hedging program. I know what markets are doing currently, okay, and I look at premium and discount. For example, if you want to study the hedging program around it, you can see markets are below sell side. Well, I think we're still gonna get here. I think it's early to talk about it. So sometimes, I also want to talk about the fact that sometimes, the drawn liquidity overlaps, with the long-term direction of the market, and sometimes it doesn't. I mean, for example, this week's trading on dollar index, we're looking at prices to return into the weekly sell-side imbalance, buy-side inefficiency. That's this CB. Because when you think about it, this market moves for two reasons. The first one is market moves to seek liquidity first, and the next one is the market moves to deliver prices efficiently. So while markets are seeking liquidity, also markets will trade, or the algorithm would deliver prices, and not just deliver prices to areas of liquidity. Okay, markets will deliver prices of, to areas in markets that aren't efficient. And what do we mean by efficiency in markets? Well, it's all in the concept of free market, really. I think it's capitalism playing in markets, because in free markets they want to give buyers and sellers equal chance, equal, this equality concept and all of that. Everyone has equal opportunities. So the market will move such a way that it gives both buyers and seller equal opportunities to participate, right? But then sometimes markets or the algorithm delivers prices in a very one-sided manner, and when that happens, it creates an imbalance. Okay, something like this. It creates an imbalance, and when it creates an imbalance and reprices into probably a discount, or probably the liquidity pool that it was locked in on, the market will now seek to return into those price levels. And when it returns into those price levels, is now giving the opposite party, to participate in the market. Okay, it's just about efficient delivery of price. Now you can see it in price action around here, when you see the market's bullish and markets sold off, trade back into this range and close bullish again. You can see all of these weeks in between. This is efficient price delivery. Okay, this kind of consolidation, what we really don't like is efficient price delivery. You can see all of the efficient price delivery here, but when market gives off like this, it always creates an imbalance. And seriously, an imbalance basically is just a gap between weeks. Okay, you can see this week, this candle low here, and you can see this candle high. You can see there's a gap between here, so that's an imbalance. But you can see here, literally no gap. You can see how this gap overlaps this candle's low overlaps this candle's high, and you can see when this candle low doesn't overlap this candle's high, you can see it creates a gap. All right, it creates a gap. So basically the algorithm would deliver prices, and not just deliver price, it would want to deliver prices efficiently. And because of that, we are thinking that, okay, while the market will seek liquidity with respect to the long-term trend, okay, the market will also seek to rebalance inefficiencies. Basically, most times they are usually internal ranges, okay, because markets don't rebalance external range. You're either rebalancing internal range. When we want to define liquidity into two segments or into two components, we are looking at external range liquidity pools and internal range liquidity pools. Okay, external range liquidity pools, we are looking at old highs and lows. Internal liquidity pools, we are looking at the fair value gaps, the order blocks and all of that, the breakaway gaps and whatever internal range PD array. PD array means premium discount arrays, or just think of it as premium discount key levels or something. Okay, but it's called an array because they are kind of like arranged in a particular format. Okay, I think we'll try to cover the lesson, but if not, we'll try to cover the lesson really. All right, for the PD arrays. All right, because my YouTube channel really, it would really benefit folks that have like the basics of the ICT concept. And what this mentorship really is doing is teaching you. I'm teaching my trading system, so I'm doing it in form of a mentorship, and I'm doing it from ground up. Where I start from when I look at the market, how I interpret price action. Okay, and my interpretation of price action, there's no way I can teach it in one lesson, and that's what the commentary is for. So the commentary is because the market price action presents in different ways, right? So they are kind of like different ways, that I'm going to still use the same knowledge to interpret price action, but that comes with experience. Okay, so and that's why if I teach this, which is actually good enough, you still need to subscribe to watching the commentary and stuff so that you can really advance in different techniques you can use to define the same things. Okay, so like I was saying, I said sometimes the activity overlaps. Now the activity of the draw on liquidity, okay, mind you, I said draw on liquidity simply refers to near-term price level. The markets are willing or unwilling to engage on the near term. Now sometimes the draw on liquidity is in line with the high time from institutional order flow. Now when I mention high time from institutional order flow, I'm referring you back to the COT data, okay? But sometimes the draw on liquidity doesn't overlap, and these are periods when markets are making some sort of high time frame retracement. Okay, for example, this week we're talking about markets trading into this level because there's clearly an inefficiency here. Okay, this is a draw on liquidity. Okay, and this is how I'm defining the high time frame institutional order flow. It may not be the long-term trend on the market, okay, but it describes the short-term price level that the markets are supposedly going to engage on the near term, okay. But first off, we looked at the previous weekly high as objective, even if we want to think that a run into the previous weekly high set the stage for the markets to trade into this level. Do you understand? So sometimes the activity of the draw on liquidity, when you define it, overlaps with the long-term trend or long-term direction, and sometimes it doesn't. So now, how do you then now manage your expectations in defining, the high time frame institutional order flow when it does, and when it doesn't? And the only way you can do that is by incorporating the high time frame PD arrays. Okay, it's with the high time frame PD arrays you can define when the draw on liquidity overlaps the long-term trend of the market and when it doesn't. For example, if you look at this old weekly gap, we're talking about how the market consolidated in this gap, and when markets finally closed below, we were looking at this gap to offer long-term resistance into our objective, which was this low here, sell side here, and into this gap. So that was the analysis in previous weeks. And markets ran previous weekly low and just simply returned back here. And in hindsight, this is how we want to this is how we manage our expectation, knowing that okay, if markets begins to show sponsorship from this level and in line with the higher time frame buys, we want to trust that this level is going to take us into sell side here. Okay, so high time frame key levels, high time frame PD arrays, just like this monthly gap. If you look at the monthly time frame, you see we kind of like had like crazy expansion the first week of March, and it's only first week of March that really delivered this, and market traded into a discount fair value gap. Okay, now it's very easy to get lost in the fact that, oh, I understand COT hedging program and the dollar index is bearish, and because of that you're looking for nothing else but bearish price action. I believe me, it's ruined. Okay, it's ruined, because the markets wouldn't only move from internal range liquidity to external range liquidity pool. The markets won't only move from low resistance liquidity run to high resistance liquidity run, and from high resistance to low resistance liquidity run. Or literally what the market will do is from high res, they move to low res, go back to high res, mitigate high res, move to low res. You understand? That's what a classic trend is all about. From high res to low res, you know, mitigating back to the high res and going back to low res, and like that. Well, I think there should be a lesson on the query runs, because my first lesson on the query run was, I think, 3 years, 2021. 2021 was not 3 years. Damn, 4 years back. All right, that was my first lesson on the query run, so I think I'm going to amplify that lesson again. All right, and everything will still be within the context of defining the high time frame institutional order flow and using the COT data. All right, and these things we're talking about now. Recall how we started. We started from talking about how the commitment of traders report, the hedging program, gives us the basis for our analysis. Then I talked about how how I used to view market structure back in the day, and how I view market structure now by simply looking at the data and then looking at each candle ranges, okay, then blending high time frame key levels. Okay, COT hedging program is bearish, and I see an indecisive candle on the monthly chart having closed the fair value gap. This is a doji from Candlestick Trading Bible. So I'm anticipating a reversal already. It's just candlesticks, all right? And from this, I then go into the weekly time frame. I use the weekly time frame to validate the monthly bias, then use the daily time frame to validate the weekly bias, and before I engage on lower time frame chart. Okay, it's always the same repetitive process. Looking at data first, looking at high time frame PD arrays, looking at candlesticks on the monthly time frame, because if I can interpret one single monthly candle, I'm not looking at all of the long-term trend. Okay, I'm not looking at any single thing, I'm not looking at any one of that. Okay, because I can already see what markets are doing, what smart money are doing in real time. I just need to go to the monthly time frame and interpret the next monthly candle. And I'm going to interpret the monthly candle in line with narrative. What's narrative? The COT hedging program. It gives me direction. And once I can anticipate the movement of the next monthly candle, I'm just going to go in every single week in line with my anticipation on the monthly time frame. And that's simply how I do it every single week. All right. I'm defining the high time frame institutional order flow based off of data and then market structure, but not using market structure as in the long-term market structure. I'm using it in reference to candle ranges, because each candlestick is market structure. Okay, look at it. This is a low and this is a high, literally. Now look at this candle. It made a what? A higher low, right? And market made a what? A high, and market made a what? A higher low. Market made what? Another high. So if this is a bullish market structure and we are still bullish, and the objective is for the markets to close this fair value gap, what will be my bias at the start of this month? Well, if you said bullish, simply bullish, because the previous month was bullish, and I'm going to be bullish this month until where market closes this gap. And when the market closes this gap, simply you want to wait, because this is key level. Well, if you're trading off of high time frame, you cannot simply go in, because institutional order flow is bearish and market has hit a key level. You can see this bearish order block. You can see this bearish order block here, this bearish order block, and the close of this fair value gap. So you can simply go in here if you're doing long-term trading. All right, and you just hold and let market express itself. Or when you want to complicate things through day trading, you want to then blend in the weekly profile. You want to look at the weekly bias. Has the weekly time frame validated the monthly bias? And how can the weekly time frame validate the monthly bias? Well, if I'm bearish on the monthly time frame, if I'm expecting the monthly candle to be bearish, if I see one particular week close bearish, that is validation. Do you understand? This month, for example, if the first week closes bearish, that's validation of the monthly bias. And if objective has not been met in subsequent weeks, I'm going to be looking for setups that's going to take me to objective. Now, what's objective? Now that you understand that each candle range is market structure, you understand that when markets trade below previous monthly low, that's objective, because now we've traded into external range liquidity pool. Why is the external range outside of this candle range? That's external range liquidity pool. Okay, so yeah, the ways you want to be looking at, prices, you want to be looking at market structure, you want to be looking at all of these things, but there is a premise to all of these things. Okay, and the premise will always be, what the fundamentals or what data actually says about it. Okay, so that being said, I would rewind back to when I was talking about how do you manage your expectations when you are defining the high time frame institutional order flow, when it aligns with the long-term direction of the market, and when it doesn't align with the long-term direction of the market. Okay, I said you have to blend, key levels, and you have to blend premium and discount. For the retail logic, then we used to, when you take the low of Fibonacci retracement and you take it to the high, whenever prices are at 61.8%, which is the golden ratio apparently, you want to be looking for trades. That's how it is, basically. 61.8 golden ratio. There's always some sort of rejection of, or some kind of continuation, just depends. Okay, now this would be our ideal 61.8 when you measure from this high. When you measure from this high to this low, you can see that the market's traded into a premium here, 61.8. Now, this is 61.8% in line with the high time from institutional order flow. Okay, and this is market in premium. What's premium market? Above equilibrium is premium. But my reference for premium is 61.8%. Okay, it's 61.8%. And you might, there are a lot of considerations for this, because look at here, periods when the market's trading to 50% into this gap. Well, if we could go back in time, you'd see how we define the high time institutional order flow here. Okay, and yeah, of course, this is a key level, this gap. Okay, as soon as market trading into this gap, the COT data here then was bearish, and you can see how the market, look at the settlement price of this candle range, kind of like settled inside here, and you can study the weekly time frame here. You can see how the weekly time frame validates the monthly bias, which was a run into this gap. But because institutional order flow is bearish, you want to see them completely close this gap, and as soon as they completely close this gap, you want to reference this as an inversion fair value gap. So the next month you want to see if markets can trade up here, and then you target the low, but you want to look at the rejection block. You're going to grade the rejection block. The rejection, the body of the candle is the rejection block. The 50%, you're going to appreciate the precision at the 50%, and ultimately you want to aim for the low. But guess what? When markets return here, okay, we're going to revisit this price action, and not here. That's not a lesson. All right. So the reason why I brought out the Fibonacci tool is just to make reference to what premium and discount is. When markets are below 50%, that's discount. And you understand, markets will move from premium to discount to discount, and discount to premium. Now, the premium market will move when the higher time from institutional order flow is bearish. It's very, very subjective. You cannot say the markets are going to run higher here to premium. And that's why, we're talking about, near-term levels, near-term premium levels, because premium and discount is very, very relative. Okay, that's what we're talking about. This level to be a premium area the markets want to return into, haven't traded into a discount. So I think we've got to the point where I should say, you like this video to support the channel, basically. And if this is your first time watching, you subscribe, like, comment, turn on your post notifications so that when I upload on my YouTube channel, you can, get the video in real time. And you follow me on my Twitter, or my social media accounts. Basically, I'd really appreciate that. I'm trying to grow an online audience, because it's very imperative this day and age that you just have an online presence, really. And personally, I have a long-term plan to use social media to promote, my business. And it's kind of like institutional level of trading, and I'm growing my following. So I'm not just sitting back waiting till when I, hit $100 million in assets before I begin to promote, my social media following. And that's why my intention is to begin doing all of that now. Okay. So that being said, we're going to go into market structure, because we want to define, because when we started with, this lesson, I was talking about how, answering the question of what the draw on liquidity is, which is, the near-term price level markets are willing to engage on the near term. Now, the near-term price level markets may be willing to engage, may be in line with the long-term direction. For example, when the weekly is showing bearish, you want to see the markets reach for previous weekly low. So previous weekly low here is the draw on liquidity. Here, you want to see, haven't seen the market close bearish. You want to see the market engage the previous weekly low as objective. You understand? So in periods like this, when the weekly bias is validating the monthly bias, you want to see the markets trade into the previous weekly low. Simply, it's easy like that. So here, the draw on liquidity here is the previous weekly low. Why? Well, this weekly closed bearish, and we want to see the markets trade into the previous weekly low, because this is in line with the monthly bias. And here, what are we looking out for? We want to see the markets trade into the previous weekly low. Why? Well, we can see the previous week candle traded into closed bearish, validating more of the weekly bias. So we want to see this candle trade into the previous weekly low first, before having consideration to see if the markets are going to return here. Okay, so basically that's how you want to define the draw on liquidity. You look at the weekly time frame, you see if the weekly chart is validating your monthly bias. And how do you get your monthly bias? Well, you see with the hedging program. Now, when you see the markets on the weekly chart validating your monthly bias, every single week you want to see the market reach for the next candle's low. In this case, since we are bearish. And now when markets go into a discount, you can see the midpoint of this bullish order block. You can see markets, found a little bit of support. You can see where, and in this case, it might be difficult to determine the draw on liquidity here, except if you just aim for the previous, the previous weekly low and you wait, because markets then return back into the range, because this was the last week of February's trading. And obviously, I think you're going to give the market some credit after giving downside for 3 weeks. I mean, she can obviously return back into range. I think that's simply one of the things we're experiencing now, because, when you look at the monthly candlestick, it has a high, the body, and the low. Okay, the low forms at key levels. And that's why I always say that, these candle ranges are capped. The weekly range is capped. The monthly range is capped. The yearly range is capped. And how do you define, where, they are likely to get capped at? Is key levels. Markets will get to key levels and respect key levels. Markets will get to key levels and respect key levels. This level here, you can reference this, this consecutive down candles here, this swing high, this mitigation block. Basically, this is a mitigation block. If you don't know, this is a mitigation block. What's a mitigation block? Oh, yeah, this is a breaker. Sorry, a breaker and mitigation block, all the same thing. Okay, this is the market ran short-term low, sell-side liquidity here, broke market structure, market returned back into this breaker. That's your high time frame objective. So you see, even if you're bearish, you need to be able to identify opposing PD arrays, so that when markets trade there, you can be able to manage your expectation on the lower time frame. Because this is a monthly key level. Of course, what happens when the markets get into a monthly key level? Market is going to show respect for the key level, of course, and regardless of what the higher time frame institutional order flow is. Regardless of what the long-term bias or what the long-term trend of the market is, markets will respect PD arrays. And you see markets is giving off what? A bullish candle. Now, if markets are in consolidation, we can literally use, this could be a validation to return into a premium to sell off. But because the market wasn't a trend, and you can see March trading was insane, right from the first week of March, market began to, show, sell-side sponsorship. Okay, so we want to use the monthly time, we want to use the data first, interpret data on the monthly chart, bring it down to the weekly time frame, and bring it down to daily time frame for day trading, executions and all of that. All right. So there's something that you should note. Okay, I think it's something you want to pen down. Okay, a market structure shift in line with the high time frame draw on liquidity is an actual market structure shift. Now, draw on liquidity in this sense is we using the draw on liquidity to define the high time frame institutional order flow. And why I would prefer to say the draw on liquidity is because sometimes the draw on liquidity overlaps the high time frame institutional order flow, is in line with the long-term trend of the market, and sometimes it's not in line with the long-term trend market. Now, I told you, how can you manage your expectations when the draw on liquidity is not in line with the long-term trend, the long-term direction of the market? You blend in the high time frame key levels. You want to look at key levels, and usually these forms are key levels basically, because when market establishes the high time frame bias, at some point it gets into a discount level. All right, it could be the previous monthly low, it could be an opposing liquidity pool, it could be an opposing PD array. Okay, and when market gets to these opposing levels, markets will show rejection. Now, this rejection could just mean the draw on liquidity on the lower time frame chart, because if this happens, if it's a monthly level, the weekly time frame can take a while to respond to the effect of the monthly time frame key level, and that's why you need to understand key levels. You need to understand PD arrays. So, what is the market structure shift in line with the high time frame draw on liquidity? Okay, say for example, we want to look at draw on liquidity in terms of the long-term trend of the market. See, September last year, the markets were in consolidation. Now, before that, you see the context, market took out sell-side liquidity here, market ran sell-side liquidity here, and after market ran sell-side liquidity there, okay, you can see markets stayed in consolidation, and we had a shift in the macro perspective of the market. Now, there are about 2 ways you can use to validate the high time frame institutional order flow, because this is the daily time frame. You can use the daily time frame market structure to validate data here. You want to use, you want to use the daily time frame market structure to validate the high time frame institutional order flow, because what gives you the signal that we are now ready to trade in line with the high time frame institutional order flow? Because it's not just about, oh, I know the COT hedging program. How do you validate the COT hedging program? That's when you use market structure. So you see that market structure bends to the will of the high time frame institutional order flow, and the high time frame institutional order flow is defined by these large speculators, producers, commercials of commodities, assets, etc. Okay, so you want to look at a market structure. And how do you look at market structure? Well, let's do it like this. Let's stay on the weekly time frame. Okay, if we look closely here, you can see markets, here market made a high, a low, a lower high, not a lower low particularly, okay, not a lower low, but they made a lower high and made a lower low, made a lower high and made a lower low. So as soon as this candle closed bullish, is that not in line with the high time frame order flow here? You see now. Now, if we look at the COT on the weekly time frame from a 12-month perspective, you can see that, here exactly, let's put it here. So here exactly, we can see the market went in bearish. We're bearish here. And And since the markets are bearish, you can see, but in terms of price action, there is no validation for these buyers. Markets are making a high. Let me move it here. Markets making a low, a high, higher low. Let's take it back. A higher high above this previous weekly high, a higher low, a higher high. You know, but what happens as soon as we have, you know, a bearish weekly close? You can see the market failed to go above this high and made a lower low. Is that not a market structure shift? You understand? You see now that when markets create a swing point, I already thought about what swing point is. A higher low, a swing high is a higher high, a lower high to the right of it, and a lower high to the left of it. Okay, I'm still thinking swing high. There are a lot of things going through my mind, and thank God for notes, because I had to note these things down. If not, I'm going to be lost in my train of thoughts. Okay, that's why I'm being able to revert back. There's no way you can say this off the cuff without losing track of what you're saying. Okay, so you can see how, you know, a weekly candle range validates the high time frame institutional order flow. Now, don't look at it in scope of, oh, this is just a bearish weekly candle. It does not mean anything. It means something when you have context. This validates this, or will I say this validates this. This means something because of this. This doesn't mean anything if this doesn't support this. Do you understand? So, and that's why you see that this market structure, okay, is an actual shift in market structure because it's in line with institutional order flow. But look at here. Market makes a low. See what we're talking about. Market makes a low. What happens? This is July's trading, second week of July, and market trade into sell-side liquidity here. Now, when markets trade into sell-side, what do you want to do? You want to wait. Why? Because markets are likely to return back into the range. I don't think this is the first time I'm saying it. Now, see what happens here. The market traded into here, made a low, and closed bullish. Now, a bullish candle close here, a bullish candle close validates what? You can see markets created what? A fair value gap. You see the fair value gap. So what will be the draw on liquidity on this week for markets to trade into this fair value gap? Why won't you be aiming for more than this fair value gap? Because institutional order flow is bearish. Because markets could literally run above previous weekly high and reverse. Of course, they did it, run above previous weekly high and reverse. Someone comes, oh, I should have anticipated this. Well, look at, you can see that this level as a draw on liquidity might become, you know, this will be the draw on liquidity. This is how you might define institutional order flow, you know, on this particular week, because this is a draw on liquidity. But you understand that markets trade into external range to return back into what? Internal range. And even if the market closed relatively bullish this particular week, because look at market structure here. Market made a low. This is a swing low forming here. Can you see the swing low? And what did I say when you have a swing low? You expect the fourth candle to return into what? The third candle's high. And why is it safe for you to just aim for the third candle's high? Because if you're wrong on the high time frame institutional order flow, is going to save you, because if you take a trade from here that takes you into this candle's high and you collapse and you wait, you want to see what happens when market does above this high. Because when market closes like this and you aim for this high, it's safe. This is the draw on liquidity, previous weekly high. Why is it the draw on liquidity? Well, a bullish close, a swing low, markets will return into the previous weekly high. That's your draw on liquidity. Okay, that's your draw on liquidity. Now, when you now blend in PD arrays, you can see this is a mitigation block. You can see the markets had a what? You see this. We're still going to get here. We're still going to get here. But when you blend in PD arrays, it now makes sense that when markets trade into this level, into premium level, in support of what the high time from institutional order flow, instead of thinking like a day trader, you are seeing market in both ways. You're seeing market from the lens of its long-term direction, and you're also seeing institutional order flow based off of candlesticks. While you're blending PD arrays, you're blending the open high low of candlesticks. Okay, you say you want to be short here. Ideally, you want to be short here. You can put your stop loss here, weekly time frame. Oh, my stop loss is too much. Well, that's why most traders don't make money on trading in forex, because they think they can always use a 20-30 pip stop loss. In fact, even a 5 pip stop loss. Sometimes you just want to assume positions in line with the higher time from order flow. It doesn't hurt. Just be there, because when you're here and market begin to favor you in this direction, you don't FOMO during the week. You're very calm, looking for best setups that is going to present. Then you can engage in high risk, low risk, high reward, or high RR, whatever you put it. Where you're targeting 5 RR and stuff. You can do it with more patience, because now you're locked in on what? The higher time frame bias. But basically, personally, I wouldn't even favor trading in line with this high, because what? I understand order flow and I know key level. Instead, I'll be waiting for prices to return here after I run above this high. Now you see that when we talk about the drawn liquidity, okay, when we talk about the drawn liquidity, when the drawn liquidity is in line with the higher time from institutional order flow, yeah, somebody asked me a very beautiful question. He said, when markets hit, previous weekly high, previous monthly high, these levels, does that mean bias has changed? Bias has not changed, because the higher time from institutional order flow predefines what happens when the market engages the drawn liquidity. If the drawn liquidity is the previous weekly low, when markets engage the drawn liquidity here, now institutional order flow is bearish. When markets engage the drawn liquidity, you just want to wait for markets to re-establish the monthly bias or the weekly bias, basically. But in this case, when you're trading against the high time from institutional order flow, and when market engages the previous weekly high, you want to wait. Why? You want to see what happens. Now that there's a key level here for reference, you want to see if market established the high time from institutional order flow, the long-term direction of the market. Because you can see we're bearish, and market has been what? Market has been bearish. So if you engage here, you're going to be on a swing trade. And mind you, there's going to be a module that defines, ideal. I'm going to do a swing trading model, okay, and I'm going to share it on my YouTube channel. I think that would be towards the end of this this mentorship. So you can see how these candlesticks validate the long-term trend, and what happens here. You want to see this candle reach for the previous weekly low. Not just that, you can see the sell side here. Not just that, you can see a small little tiny bit of fair value gap here. So you can see now it's easier to blend key levels, because you know what key levels are likely to do. Sorry. And you notice that when institutional order flow now change, market revisits areas of inefficiency. Markets want to completely close area of inefficiencies. But when institutional order flow is bearish, look at how market trade around inefficiencies. They are not completely rebalancing inefficiency, because you can see there's an inefficiency here. But as soon as the tide changes, like here, for example, you can see markets are now returning to completely rebalance these inefficiencies. That's how these markets work. From liquidity, from external range liquidity to lower internal range liquidity, to rebalance for inefficiency. But what's the context? You then utilize this. So you can see markets could actually have a fair value gap, and it's a wrong expectation that you believe that the market has to close the gap before it can offer support. That's wrong. There has to be context on the high time frame chart. This lesson is actually teaching a lot of things. I'm teaching a lot of stuff. All right. So you're going to pick in many lessons from it, and you're going to frame your own note, because I'm answering lots of questions. Everybody watching this has questions, and I'm trying to touch in many of those questions that I had, when I was a developing trader, when I was still trying to build my understanding of the market and how I want to look, like simply an X-ray view of the market. And this is the X-ray view. Simple thing, candlesticks. Candlesticks backed by what? Data. Simple. Do you use anything fancy? Nothing fancy. I've not even started talking about bearish order blocks. I've not even started talking about bullish order blocks. And these are basic things. But it's the application of the same things that define what is, advanced, because advanced concept is just an intelligent, application of basic tools. That's what advanced concept is. Now, this lecture might be advanced, but really it's just an intelligent, overlap of the basic tools. This is Candlestick Trading Bible here. This is babypips.com. So now that I talked about, how, market structure shift in line with the higher time frame drawn liquidity is actually a market structure shift. Because if the drawn liquidity here is this level here, you can see why market structure shift with candles trade above this high is valid. Yeah. But as soon as the objective has been met, and it's an objective, a premium level that supports, the institutional order flow, you can see how market will utilize it for resistance. And for every weekly range, you are expecting the market to return into what? The previous weekly low, previous weekly low, previous weekly low, previous weekly low, drawn liquidity here, markets didn't meet it. Previous weekly low, market smoked it. Sell side liquidity here, external range, because the whole point would be for markets to trade into what? External range liquidity. Okay? And because it's above this external range liquidity, you want to see accumulation of orders. That's why it starts with a consolidation first. Okay, it starts with a consolidation, and this year wasn't any different. Above relatively equal highs, it begins with a consolidation. Very abysmal price action. All right. So that being said, so while we understand that market structure shift in line with high time frame drawn liquidity is an actual market structure shift, market structure shift against the high time frame drawn liquidity is false. See, look at dollar index here, for example. We understand the institutional order flow, the long-term direction of the market is bearish. That's one way to define institutional order flow. Mind you, we're defining institutional order flow again in two ways. One is talking about the long-term trends, direction of the market, and the other is simply using the drawn liquidity. Now, the drawn liquidity is universal. Do you know why? Because it incorporates periods when markets are trading in line with the long-term direction, and when markets are making retracement, especially when they trade into premium or discount levels or trade into high time frame key levels. So that's why we would prefer to use the drawn liquidity, because drawn liquidity encapsulates, both scenarios in the market. So if our drawn liquidity here, if this is our drawn liquidity, or if the previous weekly highs are drawn liquidity, you can see a run below this low is false. And that's what ICT calls tortoise soup. Tortoise soup simply is a false run above an old high or an old low. In fact, I've amplified what tortoise soup is. When market run a swing point that's high res, that's tortoise soup. What's high res? High resistance key level, a high resistance swing point. There are certain swing points that ideally the market shouldn't go through. But when the market goes through them, it's a tortoise soup because they are likely to reject. Come on, I'm going to show you something on Twitter earlier this week, because this week is very... So, this week, market trade to sell side. Because of my drawn liquidity was a previous weekly high, even if we understood the early portion of this week was likely to be bearish, you can see when market changed state in delivery, I'm expecting buy side. This was around 2:30, and my ideal trading time is, I'm still going to talk about, my ideal trading time is 3 to 4 o'clock in the morning. And then I began to see downside on dollar index, and I saw there was a new day opening gap. Obviously waited for prices to get into this new day opening gap, and eventually market traded below this low. And I did not worry much, because in markets that ran liquidity here, transaction between opposing liquidity pools were sell side here, and markets trade into this high, and there's a change in state in delivery, and market has inverted this fair value gap. There's lots of overlapping concepts here, which I'm still going to teach in liquidity runs. Okay, you see, there are different ways to define these things, different ways. This is where knowledge comes into play. But sometimes too much information can be crazy. But that's why I show application of the same. And you can see closely here that what happened. The market traded below this low and showed more sponsorship, inverting this level. But guess what happened again? At key time of day, wanted to engage. At key time of day, London closed this particular day. And you can see how markets traded lower. Still taking sell side again. But you notice that for every time they ran below each low, markets kept on rejecting. It kept on rejecting. Okay? And anyone who is thinking that a run below this low, is sell, and you try to sell something within this range, you get stopped out. And you probably want to sell this bearish order block because you say, oh, Settle Block said a bearish order block, high probability bearish order block creates a fair value gap. It runs buy side liquidity here. I'm going to sell it. You're going to get stopped out. See, you're going to get stopped out again. That's why there has to be context. What is the draw on liquidity? So you can see, you can easily interpret market structure, that's intraday market structure, when you understand the higher time frame draw on liquidity, of course, and one or two things. But really, the idea is to get the whole concept using candle ranges to define market structure. So a market structure shift against the high time frame draw on liquidity is false, and that's a turtle soup. And what do we use turtle soup for? We use turtle soup to frame setup in line into the direction of the high time frame draw on liquidity. Okay, that's simply the reason why I was anticipating downside on euro. Downside on euro from where? You can see this high here is the previous weekly high. And when markets ran the previous weekly high and we had a change in state in delivery, because while I was looking for longs on dollar index, obviously I cannot buy dollar index, Euro USD hasn't validated bias in terms of what? Market structure for me. Because it wouldn't be just about Euro USD trading below this low. I want to see a candle close below this up candle, because that's a high probability order blocks. And that's the reason why I was talking about order block earlier this week, because I wanted to record this video and I'm going to use an order block to take a trade. So I want to show you what an high probability order block is in real time so that you can see the thought process behind it. This candle traded above buy side. This is an up candle, not an order block yet. But as soon as this candle closed below the body of this candle, validating a change in state of delivery. What's the change in state of delivery? Well, a change in state of delivery just simply defines, market depends on the time frame, because it's very subjective to time frames. Okay, when market moves from like a buy program in terms of bullish candle delivery into a sell program, or a sell program into a buy program. And how does that happen? Well, you want to reference the series of up candles. In this case, the last up candle here that ran buy side liquidity here. If our drawn liquidity is for markets returning to here, our reference point is this last up candle. If the drawn liquidity, mind you, is here, that's narrative. If drawn liquidity is here, that markets are going to return here, and we see markets trade above this high. Now, mind you, this is a market structure shift, because you can see previous when markets trading above this high, or whenever market trades above previous high, particularly is salient to bullish price action. This is just bullish price action. Oh, we run above this high. Oh, it's bullish. But why is it not bullish? Well, drawn liquidity here. And what's the drawn liquidity? If you check the weekly time frame, you want to look at the weekly chart. You want to see the weekly chart on dollar index. You see that we want to see market return into this gap, this inefficiency after trading into sell side here. So as soon as market ran buy side here on Euro USD, showed this candle, which is fine, but you can see markets failed to close below this low. But as soon as this candle closed below the bodies of this candle, this is your bearish order block. You don't need to wait for a fair value gap to get created before you get engaged. You can engage immediately this candle opens. Yes, because all of your waiting, you have it here. So what's the reason of being, sluggish again about taking entry? Oh, you want to take sniper entry? Well, good for you. You can go in immediately here, or you're going to wait for the market to return into the bearish order block. What's the bearish order block? The candle that ran liquidity here, previous weekly high. Now, remember when we were talking about candle ranges? When we talked about candle ranges, we said when markets trade above previous weekly high, that's bullish. But when we talk about the draw on liquidity, it lifts the fog and everything, because everything changes when you incorporate the draw on liquidity. Because if the draw on liquidity is this fair value gap and market trades above previous weekly high, that's a bullish market structure shift against the draw on liquidity. That's what I'm trying to say, because the draw on liquidity is no more buy side here. When the draw on liquidity was buy side here, can you see? When the draw on liquidity was buy side, whenever markets trade above previous weekly high, that makes sense. And the markets here wanted to revisit the previous weekly high. But when markets revisit the previous weekly high and the draw on liquidity is here, now the draw on liquidity here, we can need to define the weekly institutional order flow, quote and unquote, which the draw on liquidity is a short-term price action here, or short-term price objective the markets are willing to engage on the near term. But when markets engages this objective, we can then resume. We can now study price action, because we've gotten to an objective. We want to see what happens when markets trade here. We want to wait. We want to see what happens. Then when markets now re-establish a continuation, we can start aiming for next previous weekly high, the next previous weekly high, the next previous weekly high. So you can see you can use candle ranges to define, market structure. Market structure shift in line with high time frame order flow. Market structure shift run below previous weekly low, validates institutional order flow, bearish. Market structure shift when markets traded bearish again, but the draw on liquidity is here. It doesn't mean we are not still bearish, but it's the draw on liquidity. That's why the most important thing you want to do is, what is the draw on liquidity? What is the draw on liquidity? You want to spend the bulk of your time trying to discern what the draw on liquidity is. So you see now that you want to spend most of your time, trying to discern this draw on liquidity, because everything else is subject to it. Everything else is subject to it. Everything else is subject to it. And now that, for this week, we already defined, what the draw on liquidity is on the weekly time frame here, you can see a market structure shift, not just a market structure shift, a change in state in delivery. What's the change in state in delivery? As soon as this candle closed here bearish below this last up candle. On other time frames, on the 2-hour chart, on the 2-hour time frame, you want to make reference to, the series, although this is, the series of these up candles. Okay, these consecutive up candles. Now, this is a reference from the 4-hour time frame. Now that you've identified the series of this up candle, as soon as markets close below, you can see markets didn't close here, so there's no trade. So I can be doing analysis, but it doesn't mean I'm taking trades. That's anticipation. Market still has to validate my bias in terms of price, not just my bias, because I don't want to trade off of ego. Yeah, I'm not going to trade off of ego. I'm going to wait for markets to validate my bias and then engage. I'm going to sell here and expect the markets to trade into sell side here, and officially my objective. So why you can use market structure to validate your bias? Okay, looking at a market structure shift from the lens of a change in state in delivery is even more superior. You want to note that. So I hope you found this one insightful. Until the next one, be safe.